Every year, thousands of nonprofit organizations unintentionally make critical reporting mistakes that kill their donor trust, raise their compliance, and stop them from getting bigger grants. I'm talking about simple, correctable errors that auditors flag immediately. Errors that make a nonprofit organization pause before writing their big check. Errors that, frankly, make your organization look less creditable. Hello, my name is Veronique. I'm an accountant, a tax strategist, and a business coach who works specifically with nonprofits who specialize in turning complex GAAP rules into clear, compliant, and trustworthy financial reporting. Today, I'm breaking down the 12 most common, most costly financial reporting mistakes that I see. But you will need to stay to the end because the last mistake is the one that keeps your entire nonprofit organization stuck in the past. So don't forget to like and subscribe to keep your nonprofit on the road to financial excellence. Mistake number 1, misclassifying revenues. Is that government grant a contribution or an exchange transaction? Many of you get this wrong by misclassifying, which means you recognize revenue at the wrong time. You are inflating your income prematurely. Tip number 1 that I have for you today is if the founder isn't getting commensurate value and return, it's a contribution. So document your rationale. Mistake number 2 is the old retainer net asset trap. Are you still reporting unrestricted, temporarily, or permanently restricted funds? That's old GAAP. Simplify to just 2 classes, with donor restrictions and without donor restriction. You are confusing your board and your donors by doing this. So mistake 3 and 4, ignoring restrictions and conditions. A donor says funds are for a specific program, so you must track that restriction. A grant has matching requirements. That's a condition. You can recognize the revenue until it's met. Premature recognition is the fastest way to mislead stakeholders. So tip number 2 I have for you. Program staff and finance must coordinate on tracking milestones. Mistake number 5, incorrect and in-kind accounting. Is pro bono legal service? It's likely not recognized revenue unless it's a specialized service you normally purchase. Overstating or omitting in-kind donations cool your entire financial picture. Mistake number 6, omitting functional expenses. Donors want to know where the dollar goes. Are you properly allocating share costs, like for instance, salary or rent expense between program management and fundraising? If you skip this, you lack transparency and comparability. So tip number 3 I have for you, use a consistent method like staff timesheets or square footage and document it. Mistake number 7, weak liquidity disclosure. You are also required clear narrative disclosure about your financial assets and how you manage risk. Boilerplate language here leaves donors guessing if you can meet short-term needs. Mistake number 8, board designated fund versus endowments. If the board designate those reserves, they can undesignate them. They are not donor restricted endowments. So misclassifying these misleads stakeholders about the true availability of your long-term funds. Mistake number 9, missing footnotes. Footnotes are the narrative of your financials. Incomplete disclosures on related parties, concentration risk, or contingency are massive red flag for auditors and regulators. Mistake number 10, ignoring lease accounting. Almost all leases now go on the balance sheet. If you haven't recorded the right of use assets and lease liability, you're understating your organization's size and debt. Mistake 11, failure to consolidate related entities. Do you have a supporting organization or nonprofit subsidiary or control another entity? You may need to consolidate their financials. Ignoring this means you're materially omitting a large part of your organization's total economic health. Let's go to mistake 12, the existential mistake. All these mistakes add up, but the single biggest issue is not performing an annual GAAP compliance review. Accounting standards are always evolving. If you don't check for new FABs, updates, and internal compliance, you're operating with outdated policies, definitely creating errors and jeopardizing your long-term stability. Getting the financials right isn't optional for a nonprofit. is foundational for trust and growth. If you are making a few of these mistakes, you are sacrificing future funding opportunities. So how do you fix this and ensure financials are audit ready and donor trusted? Stop guessing. My firm specializes in providing the GAAP compliance review and accounting support that nonprofit organizations need to thrive. I want to help you clean up your reporting and secure your next big grant. So for the month of November, we are offering a limited number of free 15-minute financial health audits for nonprofit executive directors and board members. Doing this audit will identify your most critical GAAP risk and give you the immediate steps to fix them. Click the link in the description right now to schedule your session. Don't let your compliance be the reason you missed out on your mission.